Folks, I've been talking a lot recently about the lousy economic data and about the potential for a double-dip recession. Most importantly, the jobs numbers have looked terrible, and the report we just got out from the Labor Department for July is absolutely no exception. That report showed that the economy shed a whopping 131,000 jobs last month, more than twice as much as the economists were forecasting. Worse, the numbers for June were revised much higher, to minus 221,000 from minus 125,000. And the important other point to make is it wasn't all census-related firing. There was some concern that would mix up the numbers a little bit. When you look at private employment and you exclude all of that, you added a measly 71,000 jobs, well below the forecast for 90,000. Moreover, the numbers for last month were revised much lower, to 31,000 from 83,000. Now, it's true that the unemployment rate officially held at 9.5%, but that's only because the labor force out there shrunk again. Workers are leaving what you call the official job market because they can't find work. They're just not looking at all. If you look at those workers and the underemployed workers, such as folks who want full-time work but can only get part-time, you have an unemployment rate all in that's way up there at 16.5%. I could continue too. The household survey, which is separate from the establishment survey, showed the economy shed jobs for the third month in a row. You had financials losing 17,000 jobs. You had construction losing 11,000 jobs. You had government losing more than 200,000 jobs. And most importantly, temporary employment fell by 6,000. Folks, this is the first decline since last September. Now, when this number started turning positive, the bulls called it a sign of strength on the assumption that companies that hire temporary help will eventually hire full-time workers. Now that it's dropping, that's a leading indicator of more losses. Now, we've had a stock market rally fueled, in my opinion, by nothing more than talk of more money printing at the Federal Reserve. But that can only carry you so far. You need real fundamentals to sustain those kinds of gains, and this latest jobs report proves we just don't have them. As a matter of fact, in the wake of the data, the yield on a 2-year Treasury note just dipped below 0.5%, and the Japanese yen broke out to its highest level against the dollar, going all the way back to 1995. These are key indicators of a flight from risk, and as far as I'm concerned, they're further confirmation of the double-dip recession scenario I've been warning you about. Make sure you invest accordingly. Thanks.